Hello and welcome to this recording of our webinar, Exiting the EU, How Will It Impact Your Business? I'm very pleased to introduce Tamara Habberley, expert at the VAT People, who will now take us through the presentation and help you to prepare for the 1st of January 2021. Tamara, thank you very much. Over to you.
If there is a deal, great, because if there's a deal and we stay in on single market terms, it'll kind of leave things a little more certain. If there's no deal, then businesses that haven't considered this already are going to have major issues when they get to the end of this year. We actually exit the single market in full 11 o'clock on the 31st of December. So after 11 o'clock, anything from the UK becomes a non-EU supply, and anything coming into the UK is no longer going to be classed as falling into single market VAT rules. So what do you need to consider from a VAT and also duty perspective? Now, I will say here, I am not a duty expert. I have a smattering of knowledge of duty. It's kind of a discipline in its own right. But I will mention some of the points that have occurred with regards to duty, because you need to be aware of those and seek separate advice. So in a deal scenario, what we would want ideally is a perfect world. And the perfect world would be no change to VAT, no change to duty, because that is simple. You know, that allows everybody to continue just as we are really trading with the EU. But even if that happens, because we've left the EU, the UK has already put measures in place that will change trading with the EU, whether we have a deal or not. The UK has adopted what's called world tariff rates. You can actually access those on HMRC's website. The easiest way of getting information like this is not to go on the gov.org website and use its search engine, because that is truly dreadful. It was much simpler just to go onto Google or your usual internet browser and just click in, you know, UK Brexit world tariff rates, and it should come up with a link that explains what the rates are. Even with a deal, this will cause some issues, because the UK, if we're on world tariff rates, some of the world tariff rates for imports into the UK will be at a different rate to the EU duty rates. Some may be higher, some may be lower. Now that's fine if you're bringing goods into the UK that you sell into the UK market. Where it will cause a problem is if you're bringing goods into the UK and then send them on to the EU, or in fact any goods that come from the UK to the EU, because how will the EU know that when those goods came into the UK, the rate that was charged on the duty was comparable with EU VAT? This is on a, you know, we're staying, we've got a deal scenario. Because there, if we're under single market rules, you could potentially have goods coming into France, cleared from outside the EU, say coming in from China to France at one duty rate, and they might come into the UK at a lower duty rate from China and be then sent as an EU dispatch to, say, France, and suddenly somebody in France is getting overall a lower duty hit. And that is going to cause lots of problems, because then the EU, even under remaining in a single market scenario, is likely to want to know, have goods originated in the UK and not somewhere else with a lower duty rate? And if we do have a deal with the EU, like the deals that are coming out now with China and various other countries, you'd have to look at the free trade agreement to understand what the specific rules are within it. It will not be as simple as nothing changes, unfortunately, because we're no longer a member state. What we would want, in my view, as a country, is something like the deal that the EU and Turkey have. Because if you're sending goods from Turkey to the EU, the EU accept that those goods are of Turkish origin. They don't ask any other questions. So you don't then have to go through the rigmarole of trying to prove where your goods have originated from. That's on a deal scenario. So What will happen, assuming we've left the single market and there's no deal, and possibly even if we're still within the single market, is import VAT is going to change profoundly how it's dealt with in the UK. This is one of the few areas where there'll be an advantage to UK businesses in leaving the EU, because at the moment, when you import goods in from outside the EU, you have to pay import duty and you have to pay import VAT at the point of entry of the goods into the UK. If you don't pay that, the goods aren't released. So they sit there in the port, incurring eyewash and demurrage charges from customs to store the goods. You have to pay at the moment, you have to pay the import VAT and the duty at the point the goods clear. And then with the import VAT, you can only claim it back when you get your C79 form. FedEx or other freight forwarders documents aren't evidence to claim import VAT back. So there's always a break between you paying the import VAT to customs and you're recovering it on your VAT return. You know, so in some cases it might be 3-4 months, depending on when the goods have cleared and when your VAT return period is ended and when you're due to submit the return, between you paying the VAT to HMRC and you recovering it from HMRC. So it ties up a lot of cash flow. You've got things like duty deferment, guarantees to consider. Now, after the 31st of December, that all changes, because what will happen is you'll actually have import duty postponed, and you will have a choice in whether you want to pay that import duty at the point the goods clear into the UK, or you can wait all the way up to 6 months from 31st of December, which is by my calculations 1st of July, and you can then pay the import duty rather. It's postponed for 6 months, and you can pay that import duty at any point between that 6-month period. The reason being that HMRC are going to bring in a new duty system from the 1st of July. They haven't actually explained yet how that will work, but this is why they're bringing in this postponed duty idea, and it's also to help trade. And this will apply not just to imports from outside the EU, it will also apply to goods you're bringing into the UK from the EU. Because we'll be no longer part of the single market, they're treated as any other import from any third country. So you'll have the duty effectively due at the point of entry, but you're allowed to postpone it for a maximum of up to July 2021. And the duty will be per the UK tariff. And you'd clear making a full declaration at point of entry or the simplified declaration for up to 6 months, so up to July 2021. So you need to consider now who's going to make that declaration. Is it going to be a full or a simplified one? Is it going to be you, the business, or your agent? One of the issues that this creates from a duty viewpoint, and as I say, I'm not a duty expert, but this one's quite obvious, is if you're getting goods coming into the UK for processing, they're going to go back out to the EU again. So say they come in from France, you have some kind of process in the UK, you send the goods back to your customer in France, you're going to have a double duty whammy, because you're going to have duty when the goods come in from France into the UK, and you're going to have a duty again when the goods clear into France. And that needs to be considered really, and think about things like suspension regimes, inward and outward processing, for example, or processing in a customs warehouse, to avoid incurring that double duty hit, because duty, of course, is irrecoverable. Import VAT is going to change radically for both EU and non-EU imports. So with effect from 1st of January 2021, although technically really it's from 11 o'clock for the 1st of December 2020, but from 1st of January 2021, postponed VAT accounting comes in. And this will be mandatory. It's not an option. You just simply have to use postponed VAT accounting. What will happen is when goods come in from the EU, from any member state, or from outside the EU, you will no longer get a C79 form issued. you will no longer be paying import VAT at the point the goods enter the UK from EU or non-EU countries. Instead, the VAT will be postponed. And what will happen is you'll be declaring the import VAT on your VAT return, and you'll be recovering it on the same VAT return. Quite a similar mechanism to acquisition tax for EC goods at the moment. The difference is, though, it will apply to EC and non-EC goods. So you've got a massive cash flow saving, because suddenly, instead of having to have, for example, a guarantee with HMRC and tying up the money in import VAT when the goods clear, you're simply going to be declaring that import VAT on your VAT return and recovering it on the same VAT return. It'll be in different boxes, though. It will go in all the import VAT, EU or non-EU, will be going in box 1 of your VAT return and recovered in box 4. And the net value will go in box 7. You'll no longer be filling in box 8 and 9 on the VAT return for EU imports and EU exports, because we're no longer part of the EU. So that's quite a different process. It is a really good trade facilitation measure, though, in my opinion, because obviously you're suddenly not tying money up for anything from 1 to 3 months while you're waiting to recover it from HMRC, and you're not having to wait for the C79 form anymore, which sometimes can take, well, particularly now with COVID-19, I'm meeting clients who've got, the C79s taking 2-3 months longer to arrive with them. They can't claim the import VAT back. So that will all go. Other changes. If you're dealing with what's called low value consignments, this will change quite radically. So this is more people who are selling to end consumers, for example, in the UK. Because what will happen with low value consignments, £135 or less, that are sent into the UK from outside the UK VAT's going to be collected at the point of sale and not when the goods are imported. And it'll be UK output VAT rather than import VAT that'll be due on these goods. And low value consignment relief, which you may or may not have heard of, it applied when goods were a value of £15 or less were imported into the UK. That will disappear. There used to be a lot of planning schemes revolving around low value import VAT. So, for example, like I'm a contact lens wearer. Contact lenses, if you buy them, say from Specsavers or somewhere like that, they're sent to you from the Channel Islands. The reason they're sent to you from the Channel Islands is because they qualify for low value import relief. So you're buying effectively your contact lenses from a UK business, but there's no import VAT and no duty because they're sending them to you from the Channel Islands. That will all go, because now there'll be no low value and consignment relief. Instead, VAT will be due at the point the goods come in and are sold in the UK. Sales by online marketplaces, if any of you deal with those or have an online marketplace of your own, they will actually be classed, if they're facilitating the sale for the supplier, the online marketplace will now be liable to collect the UK VAT and account for the UK VAT. These are for goods that are coming in from outside the UK. And overseas sellers, which I deal with a lot, where they sell direct to UK consumers without an online marketplace, they'll be responsible for accounting for the VAT on goods already in the UK, and so directly to consumers. Business to business sales not exceeding £135 in value, they're going to fall into the same rules. So if you're buying something as a business that falls into this category of £135 or less from an overseas supplier, I would be expecting that supplier to be charging you UK VAT. Unless you give your supplier your UK VAT number, and in which case you'd be liable to account for a reverse charge. So the supplier in that scenario wouldn't charge you VAT, and instead you, the UK customer, the business who's bought those goods, will have to account for a reverse charge. So it's a bit like, you know, the same difference as postponed accounting with import VAT. You'd be declaring the VAT and recovering it at the same time. That doesn't apply though to excise goods, and it doesn't apply to, you know, non-commercial transactions. So, you know, your auntie sends you a Christmas present from Canada, it wouldn't fall within this. Online marketplaces, I mentioned this because I've got a lot of clients who trade via online marketplaces, and I deal with a lot of non-established businesses. Where the goods are owned by a seller who's based outside the UK and the goods are located in the UK at the point they're sold, and the seller is making a sale through an online marketplace, what will happen is it'll still be subject to UK VAT rules, but the online marketplace will be classed as a supplier. And the online marketplace will be the person who's responsible for accounting for output VAT on the sale to the end consumer. So I don't say take Amazon, for example, really good example of an online marketplace. If somebody's trading on Amazon and they're established outside the UK and they're selling via Amazon to UK consumers, what will happen is Amazon will be liable to account for the output VAT on the sale to the end consumer. The overseas seller will still have to register for UK VAT because it'll be classed as making a zero-rated supply to the marketplace. But that mechanism will be there to allow the overseas seller to recover VAT that's incurred in the UK. But this will not apply to B2B sales. So if an online marketplace is selling to a business, providing the business gives it their UK VAT number, the online marketplace won't charge VAT. And the UK purchaser, the business, will just simply recover, you know, declare the output VAT and recover the input VAT on their VAT return. And it's quite important to be aware of this, even if you're not dealing with or selling via online marketplaces, because you know, you go to, I do a lot of VAT reviews for clients, and one of the commonest areas where they have issues is they might have reps on the road, or they might have staff who need to purchase something very, very quickly of a low value, and often the purchasing in through an online marketplace. So you need to be aware of these rules and get your staff to have your UK VAT number so they can give it to the online marketplace to make sure you're not charged and have to pay VAT needlessly, because that'll just tighten your cash flow. Yeah, and we've got a question asking about the impact of VAT on cross-border services. And so we currently use reverse charge rules for EC suppliers and customers, and how will this change? Now we come on to the changes to VAT treatment to services for consumers later on in this presentation. At the moment, the services, if you're supplying them to businesses, even after 31st of December, the VAT rules won't change. So if you're supplying UK to an EU business, you'd still not charge VAT, UK VAT, if it's a supply that falls within the general rule. So what would happen there is you would just simply treat it as outside the scope of VAT, and your EU customer would account for VAT on a reverse charge. And likewise, if you're buying services in from outside the outside the UK, from EC or non-EC suppliers that fall in the general rule, you'll just simply be dealing with VAT by making a reverse charge, so declaring the output VAT and recovering the input VAT on your UK VAT return to the extent you use the supply to make a VATable supply. And as I said, I'll come on to the consumer section towards the end, because that has some interesting changes as well. So that's the Chinese curse, isn't it? We live in interesting times. If you bear with me, my slide, I just refuse to change them. So when your businesses are making sales that are not exceeding the low value, not exceeding £135, to customers in the UK in summary, where the goods are outside the UK at the point of sale, that supplier will become liable to register and account for VAT on those sales. But if the class is inside the UK at the time they're sold, so for example, being sold via these online marketplaces, the overseas supplier will become liable to account, basically register and account for a zero-rate sale, but it will be the online marketplace that accounts for the VAT to the customer. And if you're a business buying on online marketplaces, you'll need to make sure you give the online marketplace your VAT number. So exports of goods to the EU, this is where it starts to get really complicated. And it's an area that I think could easily catch a lot of UK businesses out, because most businesses I'm dealing with haven't really considered the impact. Because from 1st of January 2021, if you're selling goods under any contract terms where you've got Incoterms, so Incoterms are basically how goods are going to be treated when they're moved from the UK to outside the UK and back, both contractually and for things like export declarations, import declarations, insurance, freight, etc. The Incoterms set out who's actually responsible for all those costs and dealing with them. Now, if you're making sales to customers in the EU under terms of anything other than DDP, it's relatively straightforward. DDP means delivered, duty paid. So anything other than DDP, the UK business would be making usually would make the customs declaration when exporting the goods to the EU. Ex Works, in fact, your customer is responsible for making the customs declaration when the goods leave the UK. But basically, what it means is, providing you're not selling under DDP terms, all the responsibilities of UK business is just sending those goods out of the door, perhaps taking them to the port, and you might have, say, DAP Incoterms, where you're also responsible for doing the customs clearance for the goods, the customs declaration for the goods to be exported outside of the UK, and your liability ends there, and that's it, and that would be a zero-rated export. In the same way, say you're selling goods to, I don't know, America at the moment, or Australia, it will just simply be an export. And in those cases, the business can make the declaration that can be made by your courier, your freight forwarder, or a customs agent. What happens then, and this is the bit that concerns me, because a lot of UK businesses haven't considered this yet and the impact on their customers. A lot of EU businesses are already considering it and actually coming back to UK suppliers and saying, we've got to change the contract terms. Because what will happen now, instead of your goods moving seamlessly as a dispatch from the UK and an acquisition into the EU with no import, VAT and duty, that's gone because we're no longer EU businesses. So what will happen is, when the goods reach the EU, other than on DDP terms, the EU customer is responsible for clearing the goods into the EU and will pay the import VAT and the duty, unless the sale's below the VAT import low value scheme. So things that you need to consider that you won't have had to consider before, particularly if you only trade with EU businesses, is, are you in a position to make the export declaration? Have you actually spoken to somebody who will make it for you, like your freight forwarder? And this needs to be considered now, because you have to think about things like what was in the press a month ago. Kent is going to become the border, effectively, for goods leaving the UK. If you haven't got the export declaration process in place for the 31st of December, your goods aren't going to get into Kent. And this, certainly if you go in a different route, I don't know, by Hull or somewhere like that, to export the goods, those goods will not leave the UK unless the export declaration has been arranged. And we know, customs have already said, if lorries turn up and they're heading towards the port and they haven't got the correct documentation, that lorry will just be diverted elsewhere. And there's a good chance you would then incur eye-wateringly expensive import charges, expensive storage charges, because your goods can't leave the UK. They're just stuck there because you haven't got an export declaration. So the first thing you need to do, if you haven't thought of it already, is if you're selling on terms other than DDP, have you already thought about how you're going to deal with the export declaration? If it's ex-works, it's your customer's problem, but you still need to think about it. The other thing is your customer aware they're going to incur import VAT and duty? Because if they're not, they may not be willing to deal with you going forward if they suddenly get an unexpected charge. And also what happens if the goods reach the EU, your customer's not expecting to account for import VAT and duty, refuses to pay it, those goods aren't going to clear. And then who's going to be responsible for the storage costs? So it's all things like this you need to be thinking about now if you haven't already considered it. So, so in short there, other than DDP terms, if you're selling goods to the EU now, that is going to be an export. You need to get your export declaration process in place ASAP. Don't leave it till the last minute. HMRC at the moment are being overwhelmed by applications, so you need to get in the queue, basically. Exports to the EU, where it's DDP. Now, DDP creates a lot of issues for UK businesses because DDP means delivered duty paid. So that means contractually, the exporter is responsible both from the export declaration when the goods leave the UK and clearing the goods into the EU and paying import VAT and duty. So if you haven't done this already, I strongly suggest check your contract terms with your customers. Because if you've got any EU customers where you're supplying goods to them under DDP, 1st of January onwards, you're going to be both responsible for the export clearance from the UK and the import VAT when the goods leave the UK. Yeah, and some I'll recap towards the end about services because that is actually the final slide. I'm just mentioning that because one of the attendees has asked for that, and obviously it's quite important to their business. So with goods, if you're exporting goods under DDP terms, you, the UK supplier, are going to be responsible both for the export declaration for the goods to leave the UK and the import VAT and duty when the goods come into the EU. Now that means then you've got two processes to consider, and you'll need to be set up with an EU EORI number to be able to clear goods into the EU. The UK EORI number will no longer be a valid EU EORI number. The first thing I would say, if you've got contract terms that are DDP, is see if you can get the contract amended to take that onus away from you. Because if you can't, then you're going to have to take action to clear the goods into the EU. Now, some businesses are already finding that their EU customers are refusing to let the contract terms be amended, or indeed are actually amending the contract terms to become DDP. So likes of the big multiples like Aldi and Lidl, for example, are actually compelling UK businesses to go on to contract terms where it's DDP, with the UK business responsible for clearing the goods into the EU country where the goods go to. And that will obviously cause a massive additional burden on the businesses in terms of administration and cost. And that's quite common for people who are supplying big multiples in the Republic of Ireland, for example, that are UK businesses. So if that happens, what you need to think about is, well, if you're in the import of the goods into the EU, how are you going to recover the import VAT? You don't have to pay the duty, and that's an irrecoverable cost. But you've also got import VAT. Will the customer pay it and recover the import VAT, or will they need to pay it and they can't recover it, and they'd have to be reimbursed by the supplier? And this causes a lot of issues because technically, under DDP terms, the customer isn't responsible for clearing the goods into the EU. The supplier is. So some member states could take the view that that means that the customer can't recover the import VAT. And also, if you're sending goods to be processed in the EU, the processor can't recover the import VAT because EU law says they're not entitled to recover VAT on goods they don't own. So suddenly you've got this extra VAT burden. Can you register for VAT in the EU country where the goods are cleared? And if so, will you be able to reclaim that import VAT? If you can, it's an extra admin burden, but at least you haven't got any recoverable VAT cost in the EU. And if you do that, then you may also be liable to account for VAT on the onward supply to your customer in the EU. So these are all extra administration costs. And not all EU countries have the same rules for non-established businesses as other EU countries. And you have to bear in mind in this scenario that unfortunately, the UK is not very popular in the EU. So we do know that some countries have already said that they are going to be unhelpful. France have already said, I understand, that goods coming in from the UK into France that don't have every single piece of documentation 100% correct will not clear into France, because the French government are not happy at the fact that the UK is leaving the EU. Whilst you shouldn't really, things like this, trade shouldn't have that political dimension. In reality, it does. So if you're sending goods under DDP terms into the EU, you need to consider where those goods are going to clear first. Some countries are quite helpful and pragmatic in their approach, not just to businesses like UK businesses, but to any non-EU businesses. So a good example, the Netherlands and Belgium as well, they're set up to be they've set their countries up to be EU trading hubs. They want to be seen to be the go-to country for importers and exporters to trade through. So they are quite helpful in terms of, if you're clearing goods into the EU, if you send the goods to the Netherlands, for example, they'll be very pragmatic and helpful in how they allow you to clear the goods, how they'll allow a UK business to register as a non-established business. They have a similar form of postponed accounting to what we have in the UK. So that's usually the country I would suggest if you have the option of choosing where goods are going to clear into the EU. If you're selling on DDP terms, some EU countries like the Netherlands will quite happily let a non-established business register for VAT in their country. Others require an establishment or a branch to be set up. Some are happy for that establishment or branch to be no more than a brass plate on a door. Others require staff and human resources, and some may even require a business owner to be located in their country. And there's lots of other issues at the moment that are not necessarily VAT related, but could cause problems. For example, the EU will no longer recognise the limited liability status of UK business once we leave the EU. So that begs the question of things like, what happens if there's a dispute about VAT in the EU? Would your liability as a director be limited? It sounds like it wouldn't to me. So some EU countries as well, you may, for example, Spain's a good example. You can register as a non-established business in Spain. So you can clear goods into Spain, and you would import that at the point the goods come into Spain, and you'd put that on your Spanish VAT return. So, oh, well and good, mirror image of what happens with UK VAT. You then sell the goods to a customer who's in another EC country to Spain. What you would have is you'd have the VAT you've incurred in Spain on your Spanish VAT return as a non-established business, no output VAT because the goods have gone outside of Spain. Now in the UK, you'd be able to get that VAT back. If you were a UK business in a repayment VAT position, HMRC will pay you the VAT back. In Spain, I understand that the VAT that you're due back from the Spanish tax authority is offset against future liabilities. And obviously, if you're only clearing goods into Spain and sending them to other EC countries as a zero-rated dispatch from Spain, you're never going to be in a payment to the Spanish tax authority position. You may not ever get your VAT refunded. And I would suggest if you're clearing under DDP terms and you have to register for VAT in those countries because you want to recover the import VAT you're suffering in those countries, you need to get VAT advice to make sure that it is actually possible to get the VAT back for your VAT return in that country, because the rules are not the same in the UK as in the UK, and each individual EU country, although we're supposed to be operating under the same single market rules, all have their own slightly different local quirks. So that's clearing under DDP. So in summary, if you can, avoid having a contract where it says DDP UK supplier clears into the EU, because it will cost you potentially a lot of costs, because you'll have import VAT into the EU, as well as just the documentation. You'll have import VAT into the EU and you'll have import duty. So it's increasing your cost of making that supply. You'll only be able to recover the import VAT if you get VAT registered in the EU country where the goods are clearing, and that will be subject to that country's rules. So if you can, don't do DDP. But you may find, particularly if you've got customers who are quite, powerful in terms of their impact on your business, you may find you've got no choice in the matter, because the customer might walk away and say, well, we don't want to deal with the import VAT. So we've got another query here, which is if the order is being fulfilled by the likes of Amazon but are sold by a third party in China, what does this mean? Well, if it's being fulfilled by Amazon but the supplier is actually in China, what I would expect post the 31st of December is that the Chinese supplier would still have to register for VAT in the UK, but Amazon would be the person who would be responsible for declaring the output VAT on the sale, unless the business who's buying off the Chinese supplier via Amazon gives Amazon its UK VAT number. That's how I understand it to work at the moment. There's quite a good section on the gov.org website on the changes to OMPS, to these online marketplaces from the 31st of December, and it is well worth having a look at them. And if you look at that and it still makes no sense, because the trouble is I read these things, and because I speak this weird foreign language back, it makes sense to me, but you may look at it and think, no, it doesn't. If that's the case, by all means, contact me afterwards. I'm happy to try and translate it further. But in principle, the way I understand it is Chinese suppliers selling into the UK via online marketplaces. It's the online marketplace that will be dealing with the VAT going forward on the onward supply to either an end consumer plus UK VAT, or to a business plus UK VAT, unless the business has given it its VAT number. So the other big change which will come in is triangulation. Quite a few of my UK clients are being hit by this, because at the moment, whilst we're in the single market, with triangulation, you can have a UK business and a business who's a supplier in another EC country and a customer in a third EC country. And with triangulation, it's relatively straightforward, because, for example, UK business, in my example here of the UK business, it buys goods from a supplier in another EC country. So say, for example, it buys goods in France, and then it sells those goods to a customer in Germany. The goods don't come into the UK, because why would they? It just adds to the freight and the shipping costs. So the goods trundle from the supplier in France that the UK's business has purchased the goods from, to the UK business's customer in Germany. And that keeps costs down. At the moment, in that scenario, that falls into the triangulation rules. So the UK supplier at the moment has no VAT issues, no EC VAT issues, because it simply gives its VAT number to the French supplier, so the French supplier can zero rate its supply. And then it also treats the supply to the German supplier as just a zero rated triangulation transaction, no UK and no EC VAT. And the German supplier, in my scenario, when the goods come to it from France to Germany, it accounts for the acquisition. So it all flows seamlessly. Come 31st of December, we're no longer part of the EU, so that transaction chain just falls over from a VAT viewpoint. Because what happens is the UK supplier from the 1st of January no longer has an EU VAT number. So the supplier it's buying goods off in the EU, say my example, the French supplier, it can't zero rate its supply anymore because it's not supplying those goods to an EU VAT registered customer. It can't zero rate them as an export because the goods are staying in the EU. So the French supplier in that scenario, or whatever country the supplier is based in, that will have no choice but to charge VAT in its country to the UK customer. And the UK customer, meanwhile, has got goods that are trundling from one EU country to another. So when those goods get into that EU country, the UK supplier has an issue because it's been charged EU VAT by a supplier in one EU country, which at the moment it can't recover. And it also will be making an onward supply to the customer in the third country, which will be in theory subject to VAT in that country, because the UK supplier will be classed as the acquirer in the EC country and responsible for accounting for the onward sale to the customer in the third EC country. So in that scenario, unless the UK supplier wants to suffer irrecoverable VAT, he's going to have to register for VAT in the country where the goods are sent to, and then account for EC VAT on the onward supply to his EC customer. And if he doesn't do that, then the cost of making that supply has gone up by at least, depending on the VAT rate of the supplier's country, at least 20% additional cost on top to make that supply. So if you're involved in triangulation, you need to think very carefully about whether you need to register VAT in another EC country to account for that transaction. Real life example, I'm helping a client at the moment where their goods come from Poland to the Republic of Ireland. The Republic of Ireland will be staying in the EU and the UK will be leaving the EU. And in that case, what we've had to do, because they can no longer use triangulation, so the Polish supplier would have to charge them Polish VAT. The client's registered for VAT in the Republic of Ireland. So it can account for the acquisition of the goods in Ireland, but it will also have to charge VAT to its Irish customer. And we've got all that organised, and I've said to the client, you have remembered to tell your Irish customers you're suddenly going to be starting charging them Irish VAT. And he said, well, that's a good point. So you need to make sure in those scenarios, if you're now registering for that in another EU country, your customer's aware of that. And it's not just assuming that it'll be accounting for acquisition VAT as an in and an out. It'll actually be charge VAT that you'll need to pay to your business, for your business to then pay it to the tax authority in the country where you're registered, unless that country has some other form of simplification. So that's another complication. The other very strange complication is the impact on Northern Ireland, because Northern Ireland is obviously part of the UK. This has been disputed for some years. Fortunately, as the political situation has been settled for a fair time in Northern Ireland. But we've got this backstop agreement to consider, and the backstop agreement is very political. And without going into politics into greater detail, the other issue we've got now is the change in the American presidency, because Mr. Trump was very pro the UK leaving the EU and anti the EU, and pro Northern Ireland being seen as part of the UK. The new incoming president, when he finally manages to get into the White House, he has in the past been very pro the EU and anti, so the UK leaving the EU, and very, very pro a united Ireland. Now, you know, I'm not here to comment one way or another on that. My only interest in it really is the fact that that has an impact on how we deal with VAT going forward. This applies into Northern Ireland, because Northern Ireland will remain part of the UK for VAT purposes for at least the next 4 years. That's the length of the backstop agreement. So if you're selling goods from the UK, from mainland UK to Northern Ireland, you'd still be showing UK VAT on your sale of the goods to your customer in Northern Ireland, same way you would to any other country. But where the oddities start is if you move your own goods from mainland UK into Northern Ireland, you'll be creating a liability to account for VAT on that movement of your own goods into the Northern Ireland, and you then recover that as input VAT on your UK VAT return, even though the goods, it's your own goods, just moved into Northern Ireland. What that means is, say you're sending goods, I don't know, you move your own goods to be stored at a warehouse in Northern Ireland to sell at a later date, you will have to be treating that like it's almost like it's an export and an import on your UK VAT return. And if providing you're using the goods to make VATable supplies, you just recover it as import VAT. So it's suddenly creating this liability to account for VAT on a movement of goods from the UK to Northern Ireland. I believe, although I've looked again and the gov.org website has suddenly changed, but I believe that box 2 on the VAT return will be used for these sort of transactions. But it's not entirely clear, because as I say, the page that I was looking at that explained that has moved, has mysteriously disappeared, because HMRC, like everybody else, you know, they're having to react all the time to all these changes. Yeah, so UK businesses, if you're moving your own goods into Northern Ireland, you'd be effectively declaring output VAT and recovering import VAT on your UK VAT return. And you would only be charging UK VAT if you're actually selling goods where you've sold them from the UK mainland to a customer in Northern Ireland. Simplification rules that you might have been able to use if your goods were in Northern Ireland and sold to customers in another EC member state, like triangulation, you won't be able to use that if you're selling to customers in the EU. And also things like second-hand margin scheme. So say your car dealership, and you've got a dealership in Birmingham, and you've got a dealership in Northern Ireland, and you sell a car at the moment to a customer in the EC. If it's second-hand car, you use the margin scheme, you count for VAT on the profit margin. Now, well, I should say by now, 1st of January, if you sell those goods to an EC customer from either the UK or Northern Ireland, you can't use the margin scheme. It'll be an export if you sold under terms other than DDP, and your customer will be accounted for import VAT when the car reaches the EU. And it also means then, if you're dealing with dealerships where they've got EU dealerships and UK dealerships, a car moving from a UK dealership to an EU dealership post 31st of December that can't be treated as a margin scheme item by the EU dealership. They'd have to recover import VAT and account for VAT on the full selling price in the EU. So again, another difference in VAT accounting. We've got another couple of questions here. So somebody's asked, is this the same for services? No, at the moment we're dealing purely with goods. Services will come on to later. And Richard has asked, we've got goods going from Estonia into Northern Ireland. How will they be affected? Well, you can be affected, unfortunately, quite profoundly, because Estonia, if the goods are coming into Northern Ireland from an EU country or a non-EU country, to get those goods in, you'll be incurring import VAT and duty. So somebody will have to clear the goods when they come into Northern Ireland. But via your UK VAT return, you would be using postponed VAT accounting. So you'd be declaring the import VAT and recovering it on your UK VAT return. And you just have a duty charge to pay. That's assuming the goods are being sent to your DDP. So if you send DDP, the supplier in Estonia would be the person responsible for clearing the goods into Northern Ireland. So you need to make sure your processes are in place to clear those goods when they come into Northern Ireland. So it'll be classed as an import into the UK effectively, if that makes sense. So it's an additional compliance cost to you in terms of if you got, if the goods are coming to a port or an airport in Northern Ireland and you're responsible for clearing those goods, you're going to have to make sure that you've given the freight forwarder your GB, your number to get those goods cleared. Otherwise, they're just going to sit there at the airport and you'll be charged a lot of money to store them. So distance sales, I don't know if anybody here listening to this does distance sales. They may do it and not be aware of it. What happens is now, obviously, because the internet has, and particularly with COVID, the internet has driven the sales by the internet massively, because people now are just sitting at home, they're buying goods. Instead of 20 years ago going down the corner shop or going into town if you wanted something, or having to search to find a supplier of specific goods, you just go online, and you might be buying your goods from anywhere. The goods could be in India, they could be in China, they could be in Birmingham. It makes no difference to you as a customer, because you can just buy the goods, you can order off the supplier. Now, if you're in that scenario where you're a business that's selling via the internet to EC consumers, at the moment, you'll be charging plus UK VAT because your EC customer is not VAT registered in the EC. Once the sales go over certain thresholds, and this is purely for physical goods that we're talking about now, once you go over certain thresholds that vary between €35,000 to €100,000, depending on the EC country where your customer is based, as soon as your sales in that country hit that threshold, you should actually stop charging UK VAT, and instead you register for VAT under something called distance sales, and you start accounting for VAT in the EC country where you're selling the goods. And I'm realising now, I'm starting to run out of time, but what will happen is that when the goods go into the EC, at the moment, you'll be using distance sales. 1st of January, your distance sales registration will become invalid, and you'll be simply exporting the goods free of UK VAT to your EC consumer. And from the 1st of July, the rules will change yet again. This is nothing to do with Brexit. 1st of July 2021, the EC is bringing in what's called the one-stop shop. This is EU-wide. What will happen with the one-stop shop is UK suppliers selling to consumers in the EC will have to sign up and register for the one-stop shop and declare VAT at the rate applicable for the country where the customer is based. And to sign up to EOSS one-stop shop, you have to choose an EC country and register for VAT in it. as a non-established business, most people choose Republic of Ireland, primarily because the Irish speak English, so it makes them an easy tax authority to deal with. You've got quite favourable direct tax regimes as well, I understand. Now, so what will happen is you're supplying goods to an end consumer, physical goods in another EC member state. 1st of January, your distance sales registrations will be cancelled, become invalid. You won't charge UK VAT because you're exporting the goods. So instead, your goods will be sent to the EC, no UK VAT, unless those goods fall into the low value consignment threshold. Your EC customer will have to pay input VAT and duty to clear those goods into the EC. Now, if they're an end consumer, they might not be expecting that. They might not be willing to pay it. So you then got goods that are stuck because nobody paid the input VAT and duty to clear them. You might end up with a dispute with your customer. You might also lose your customer base. So you need to think, if you're selling to EC consumers selling goods, think now how are you going to deal with that for this period between the 31st of December and the 1st of July. After the 1st of July onwards, you'll have to be registering for VAT in an EC country and accounting for VAT on supplies to EC consumers via this one-stop shop. And that's going to be quite a big change for a lot of UK suppliers. And that brings us on quite neatly to services, because services, they won't be changing for a while, but then they'll be hit by this one-stop shop, this new EC-wide mechanism. So what will happen is, if you're a supplier of services, the VAT rules won't change. The place of supply rules aren't changing in any way, shape or form for services. So if you make a service where the place of supply is another EU country, in general, the customer will, if it's a B2B supply, the customer will still be the person who's liable to account for VAT in the EC. The UK business would treat it as outside the scope of VAT. If you're making a land-related supply in the EU, you become liable to register and account for VAT there, depending on the local country's rules. But most supplies coming from things like consultancy, for example, it will remain outside the scope of VAT if your customer's in business. And it would plus UK VAT if your customer is not in business. What will happen is, at the moment, particularly for digital supplies, this is going to have a big impact, because digital supplies will know their EU VATMOS registration will just disappear. And if they've been under the £10,000 a year threshold that allows you not to have to register for EU VAT when you're making digital supplies and services to customers, that threshold will disappear. So 1st of January onwards, suppliers of digital services will need to register for the non-union version of VATMOS, no matter how low the turnover is, and account for VAT on the supplies to EC consumers. That's purely for digital services. Any other EC supplier of services, business to business, no UK VAT. There is also rules that allow it to be treated as no UK VAT if your business is to end consumers that fall into and the suppliers fall into this category of things like intellectual services. But 1st of July, this one-stop shop comes in, and this is a big change for service suppliers, because it replaces VATMOS with digital services. So people signed up for VATMOS have to go, oh, not again, and have to sign up for this one-stop shop. But other suppliers of services to consumers in other member states will also have to sign up and account for VAT on the one-stop, using the one-stop shop, instead of being able to treat the supplies outside the scope of UK VAT. So give you an example, a real life example. I've got a client who's trying to think of the best description for him. He's kind of like a fortune teller. He does fortune telling astrology, and so now, come 1st of July next year, he will have to sign up for this one-stop shop, to account for any supplies to EC consumers. So that's going to be a big change for him. Business to business, it'll still be the same rules, that your business supplies will be outside the scope of UK and EC VAT, with your customer accounting for VAT under reverse charge. But for supplies to consumers, it will be a massive change. If you're supplying services to consumers, digital or non-digital, consumers in the EC, you need to start thinking now about how these changes are going to impact on your business and how you account for VAT on those supplies, and also things like, how you charge that service. Because obviously, if you're using the one-stop shops, you've got a liability to account for VAT in the EC. You're going to have to think about, do I charge all my customers £10 each? If that's the value of your service, do I charge them all £10 each and lose a different amount of my profit because it'll be different VAT rates that you're stripping the VAT out and paying via the one-stop shop to the different member states where the customer is based? Or do I charge £10 and add a different VAT amount on, depending on where the customer is based? And that will change, particularly if you're selling services via your website. That will change your pricing policy and how much your customer is paying you in practice. And these are things you need to think about now, because the IT changes it's going to require will be quite significant for you as an organisation. So I saw a very short summary of what are, really significant issues. It does look like we're going to leave the EU without a trade deal. Having said that, it wouldn't surprise me if we got to, because this year is been such a bizarre year. We'll get to the 30th of December and the EU goes, oh, no, stay. But I think in reality that's unlikely. And even if there is that faint possibility, you need to be putting measures in place now to protect yourself in a worst case scenario. And even with a trade deal, the exit's going to cause significant issues for things like, duty costs. So really recommend advanced planning. I mean, I would say starting to plan now is a little late. So if you haven't started doing anything to plan for these changes, you need to do it now. You can cushion the impact significantly by ensuring that your goods can actually exit the UK from the 31st of December. So get the clearance procedures in place now. Work out now what you're going to do, who's going to clear the goods, who's going to do all the export declarations. Is it going to be you? Is it going to be freight forward? Is it going to be your customer? Look at who's acting as the importer and paying the VAT and the duty when the goods reach the EU. If possible, avoid DDP terms, because if you can put the onus on your customer to clear the goods, it's going to make life a lot easier for you, but that's not always possible. Consider how to account for EU VAT if you're buying goods in the EU from suppliers to sell to EU customers, where the goods remain in the EU. There's in all probability you're going to have to register and account for EU VAT. You might even have to create an establishment in the EU. Make sure you're aware of all these changes are going to come in for delivered goods to EU end consumers, because the accounting procedure is going to change twice. They're going to change when we leave the EU, and they're going to change when the one-stop shop comes in. And try, wherever possible, to avoid double duty costs, because otherwise it's just going to be stripping your profit out. The other thing is that I haven't mentioned earlier is at the moment we've got a VAT reclaim mechanism where you can recover VAT if you're based outside the EU and incurring VAT in an EU country. There's a lot of speculation that without a trade deal, because we haven't got a reciprocal arrangement, if you're incurring VAT in other EU countries and you're not registered in that country, you won't be able to put a claim in. So you need to think about these things now. So in short, be prepared. And I realise that this is probably not the most cheering of presentations, but what I want to do is ensure businesses are really aware, where possible, of what they need to do, and seek advice from Jerem, seek advice from trade organisations, from us, from my firm, we've got a sister firm, the customs people, or even just your freight forwarder, but make sure you've done something now to be prepared. That's it. So if anyone's got any questions that you want to ask via the question facility, more than happy to help. So we'll not have trade deals with third countries. The EU has deals with. How will this affect the supply of services to third countries? Well, from a UK perspective, it doesn't make any change because at the moment, the UK is going to stay under the same place as supply of service rules. So what you would have is, for anything that falls under the general rule, you wouldn't be charging UK VAT, and instead your customer would be accounting for VAT or the equivalent in their country. So say you're supplying to Gulf Cooperation Council member states, so that's Dubai or UAE, something like consultancy services, you would be charging them VAT, and they'd be accounting for that under reverse charge under their version of VAT. So at the moment, as far as I'm aware, from a VAT perspective, it doesn't affect supply services. So has anyone got any more questions? Or are you all still reeling from this? I mean, hopefully a lot of you have already put measures in, and I'm telling you nothing that's new, but my concern is the businesses that haven't done that. Right, someone said we're not clear on when I charge VAT on sales invoices. So is this for goods or is it for services? And who is your customer? Would be my questions. Because for goods, if you're selling goods to an EU customer who's in business, so you're sending the goods out from the UK, you wouldn't charge them VAT because you're simply making an export of goods. If you're supplying services that fall under the general rule, you wouldn't be charging you certainly wouldn't be charging your business customers, and probably not also your non-business customers, EC VAT from 31st of December. But from the 1st of July, with services, the rules will change. So if you're supplying services to EU consumers from the 1st of July onwards, you'd have to sign up for the one-stop shop and charge VAT at the EU rate applicable.
Thank you very much for watching. If you have any further queries, please do not hesitate to get in touch with us via the Contact Us page on our website. All details are included below. Thank you.